whatever views that I present to you, they are not the whole market. There's a lot of methods out there. There's a lot of methodology. There's a lot of, types of analysis. We can't discuss everything in one Zoom meeting, but I'm going to try as much as I can to be as concise so that you understand what we're talking about, okay? And then some of the concepts that I'm going to share, I don't have the copyright to that information, okay? So kindly bear with me. I'm only sharing information that I've come across as a trader over the years that I've been trading, okay? So I'm just here to share knowledge. I'm not here to advertise anything. I'm just here to share knowledge with you guys, and hopefully we can all be profitable traders at the end of the day, okay? So let's establish some few ground rules. I will speak. I've already muted your microphone, so I'm sure there's no noise in the background. The session is being recorded. I've tasked someone to record the session, so it will be shared at the end of the meeting. And then we're going to create a group for the purpose of sharing the video. And the group will be destroyed as soon as people are done downloading the video. So it's not going to be a continuing group, okay? I'm not trying to put you guys into a group, okay? And then the floor will be open for questions at the end. So whatever questions you come across, just take them down as we go. And then some of them just put them through the chat. And then what I will do is I will go through them and then answer as we go as well. Okay. So the meeting has started now. I'm going to cover market maker cycle and the dealer trend, one and the same thing. I'm going to cover entries and exits. Now, I know a lot of traders know when to enter, but a very few know when to exit the market, okay? So I'm going to speak on entries, I'm going to speak on exits based on the market maker cycle or the dealer's trend. And then I'm going to also talk about spotting stop hands or false moves. And then I'm going to maybe touch a little on trading news. So the first thing that I'm going to talk about now would be the market maker cycle, okay? So there's a classic example that I always use to illustrate to my to the people that I teach sometimes, that as a retail trader who is trading against institutional traders, you are like a fly that is going on a head-on collision with a train, okay? You cannot afford to go on a head-on collision with a train if you're a fly. You're definitely going to die, okay? So what you need to do is you have to go in the same direction with the people who have the money, who can move the markets, okay? The markets move based on demand and supply. And the concept of demand and supply would have it that the person or the party who has more money can actually create demand or create supply, okay? So I'm not going to really get into defining what a market maker is, that you can look up on Investopedia, okay? But what I want you to understand is that there are banks and institutional traders that can manipulate the prices in a market, okay? In terms of manipulation, what are we saying? Are we saying that they go to MetaTrader and maybe change the prices that you see? No, I'm not talking about that. I'm talking about movements in terms of placing a certain volume or reducing the volume to actually move the price in a certain direction, because the price is a function of demand and supply. Okay, so I've heard a lot of people say it's manipulation on the platform, on the date, the spreads, but I'm not here to talk about the spreads mainly. Okay, I'm here to talk about the cycle. So you have to understand that there is actually one thing called a dealer's trend or the market maker cycle, which you have to be able to identify in a market for you to be a proficient trader. Otherwise, if you go with what is written in books about how the markets will trend, where the support or resistance will be found. Okay. Someone is saying, my apologies, no offense. Can you make it a bit quicker? Okay, fine. So let me try to make it a bit quicker. Okay. Right. So yes, how is price manipulated? Price is manipulated by volume, and some would ask, is it real and is it fair? Yes, it is fair. It's all fair in the game of trading. You have to just move from the knowledge that you think you have and maybe try to look at the market in a different way, okay? There's what they term inexplicable market behavior, where you see the market behaving in a certain way, and you can't really explain. There's no news there. There's no event that has taken place, but you see the market moving in a certain way. That's market manipulation by market makers, okay? I'm not going to delve into currency rigging and how it's done. But let's look at the dealer's trend, okay? Let's get straight into it. Let's look at the dealer's trend. So I'm going to share a whiteboard so that you can understand what I'm talking about. So the market maker traps traders at the beginning of either a session or a week or a day, okay? Or at the end of a session, the week or day. How do they do this? What they usually do is this. I'm going to show you examples, okay, on the chart, so don't worry. This is what they do. Let's say this is the Asian session. This is the Asian session. The market is moving. This is the Asian session. The market is moving. At the end of the Asian session or the beginning of the London session, you may see a spike to the upside at the changeover between the Asian and the London session. You may see a spike to the upside, and then the market will move the actual direction that it has to move for the day. Now, what really happens is this. The market maker has got information about the volume, okay? What volumes are there in the market? How are people trading, okay? So what happens is this. There are people that are maybe the previous day or the previous session, there are people who sold and they're anticipating the price to go down, okay? So while these people are anticipating the price to go down, the market maker spikes the price so that they can hit the stop losses and also trigger stop orders. Once this is done, the market moves in the direction that it has to, or that it actually does. So you find a lot of traders, this is what happens. They are trapped. It's as if most traders, when they trade, immediately when you enter into your trade, it's as if the market has been told that you've entered into a trade and it starts to go the other direction. The reason is the textbooks that we've studied, or the market that we've studied, or the market that has been presented to us by the general textbooks out there, talk about breakouts, they talk about patterns, but they don't talk about the dealer's trend, which I will get into, which I'm actually talking about right now, okay? So how do you know, or how does the dealer actually move, okay? The dealer moves in 3 cycles, okay? The dealer moves in 3 cycles. They create a peak formation, either to the low, maybe in form of a double bottom, the one that you may already know if you actually know what a double bottom is. I'm going to explain. And then they move 1 cycle, then retrace or pull back, move 2nd cycle, retrace or pull back, and move 3rd cycle and form another peak. Okay. I'll explain the reason why as well, that these cycles are 3 cycles. Okay. The reason why these cycles are 3 cycles is because usually the human mind is conditioned to do things in steps of 3s. Okay. On your marks, get set, go. 3, 2, 1. You know, 3 is a magical number according to our human psychology. So the same applies with trading. In trading psychology, what the market maker does is they push price for 3 consecutive levels before reversing, so that they induce you into taking the trade. So what will happen is this: they'll push the price initially. You haven't spotted the trend. You think, let me just wait and see what is going to happen. The price goes down a bit, goes up again. Then you're like, oh, so I think the price is actually moving up. So what happens? They push the price the 3rd time. And the 3rd time, usually, this is where many people enter. Now, as people enter on the 3rd cycle, there's a lot of volume. Now the market maker can reverse that. Okay, so the 1st time, the 2nd time, and the 3rd time, they're pushing so that they induce you into taking trade. Okay, let me show you maybe a representation in terms of what happens during the day. Okay, let me branch my analysis into Asian session, London session, and then the New York session. So what happens during the Asian session, most of the times there is not much movement. Okay. Okay. So what happens is, when I look at the Asian session is usually just consolidation. Please note, I said usually, I didn't say every time, okay? The Asian session is usually like a consolidation. There's not much movement in the Asian session. So what happens when we're coming out of the Asian session, the market can spike up, which would be a false move, okay? And then it goes down, which is the actual trend for the day, okay? And then after the trend for the day, okay, I'm going to show you these examples on the chart. Okay, fine. I'm seeing someone who's saying show these examples on the chart. I'm going to show you on the chart. So let me explain what actually happens and then show you on the chart. Okay.
Thank you. Thank you.
So, so what happens is this. During the Asian session, the market is usually in consolidation. And then after the Asian session, the market spikes in the opposite direction of where it actually wants to go. So there's a huge spike at the transition there between the Asian and the London session. The market goes down. And then when the market goes down in the London session, that's the actual trend, okay? Let's say at the end of the London session, the market shows something like a sign to want to come back up, okay? That is also another false move. The market will continue. Now, I want you to understand this one thing. If the high of the day, which we call the HOD, if the high of the day is not set in the London session, it will be set in the New York session. If the low of the day is not set in the London session, it will be set in the New York session. So if the market consistently goes in one direction the entire day, it cannot come back to the open, to where the market actually opened, the opening price of the market. Why? Because there's a lot of traders that have been trapped in the Asian session that were trying to, people who bought during the Asian session. So for them to be trapped, the market maker cannot make the price to come back up to the opening. So let me show you these examples on a chart so that you get to understand what I'm talking about. This is not, fake. I'm going to show you that this is not, something that is fake. Let me start my MetaTrader so that you can really see. Okay, I have someone on the charts there. Okay, so just bear with me. My MetaTrader is opening. I have a lot of applications on my laptop that are opening right now. So let's hope this is just a few seconds and then we can get here. Okay, fine. So it's there now. Let me share my screen. Okay, let me share my screen. Or just share my chart. All right. So I want you to see something. Okay. Now this cycle that I'm talking about, the market maker cycle, it is applicable in terms of sessions. It's applicable in terms of days. Okay. So let me show you something. Let's go to Euro USD. Let me try to show you something. 10 April, 9 April. Like, let me put something red there. 8 April, 9 April. I can just show period separators there. Okay, fine. Let me remove these red lines. So let's look at the 15-minute chart first. Now, this is what I'm talking about, okay? Look at this. Your Asian session is not much movement. It's just consolidation. Let me get a pen. Right. This here is your Asian session. There is not much movement. It's just something like a consolidation, okay? And then the market spikes to the downside. Like I'm saying, the spike, a shadow, the candlestick below there at the beginning of the London session will be a wick, and then the market starts to go the actual direction where it wants, okay? As you can see. Now, as the market goes in that direction, let me check the timings for you so that we can talk in terms of time as well. Okay, crosshair, right. So with my server time, 1500 hours is when the US session starts, okay? So there, round about there, that's when the US session started. We have a spike to the downside, which is a sign that the market is not going to go down, okay? When the London session started, we had a spike to the downside, which meant the market is going to go up. And then when we started the US session, we had a spike to the downside and the market did not go down anymore, okay? So the following day, same thing. You look at the Asian session, we have some pattern here. The market spikes to the downside, goes up, then comes back down. US session, right? The market spikes to the upside, which means it's going to go down. Unfortunately, there wasn't much movement here, so I'm going to give you another analysis as well, so that you can actually see what I'm talking about in terms of the market maker cycle. Okay, let me show you the Euro USD as well, from the 6th of March. Right, 6th of March, 6th of April, sorry. From the 6th of April to the 10th of April. Now, like I said, the same concept that we can apply in terms of sessions can also be applied in terms of days. Monday is like, oh, okay, if you understand the market formation, then how come moving? I'm going to explain as well. When I'm talking about entries, these moving averages, they actually help in actually getting entries for counting these various levels. Like I said, the market moves in 3 levels, okay? So these moving averages, that's my tool, that's my weapon against the market maker, okay? It actually gives me an advantage to actually count the levels and be able to know when the markets are going to turn, okay? So you actually see that this method that I'm going to teach you is going to make life so simple for you. There is not many problems that you actually encounter when you are using the moving averages. So let's look at the cycle. Understanding the cycle will also help us. But otherwise, when we get to the moving average, you actually see it's actually simpler. Okay. So this is what I'm talking about on Monday, right? This is the beginning of the week. Like I said, the beginning of the week, we had a spike to the downside, which meant the market is going to move in the other direction. Okay. So if you're going to trade for days, you're going to be a day trader or you're going to be a swing trader, what you're going to look at is what was the spike on Monday. Okay. The spike on Monday was to the downside, so the market moved up. It moved one level up. Then it went back down into some form of consolidation. Then moved the second time, this is level 2, and then consolidated again. Then I'm anticipating a move to level 3. That's what I'm anticipating on EURUSD. Now, all these levels that I'm counting, all this anticipation that I'm doing, I say what you need to look at is the beginning of the week. Okay. If the market moves in one direction at the beginning of the session, most of the time it means the market is going to go the other direction for the trend. Okay. So let me share a white screen again to explain what I'm talking about a bit before we come back to the charts. So we have what I would term the weekly trend, right? The weekly dealer's trend. Monday is consolidation. Tuesday, okay, end of Monday, there's a spike to trap traders who are trading either to the upside or to the downside, depending on where the market wants to go. So there's a spike to one side, and then the market starts to move the other side on Tuesday after the Asian session, but Tuesday. And then let's say this is your level 1. The market will continue on Wednesday to level 2. Yeah, Wednesday, level 2. And then Thursday will be your level 3. Now, I want you to understand this one thing, okay? The market marks the high of the week either on Wednesday or on Thursday. When the market marks its high of the week, never trade against the high of the week, okay? The market will mark the high of the week on Thursday and then maybe end Friday in consolidation, or it may move one level on Friday. But definitely Friday and Monday don't be trapped in the market. Don't trade on Fridays, on Mondays. That's when there's a lot of trap volume. The market makers trap a lot of people at the beginning of the week and at the end of the week, or at the beginning of the day or at the end of the day. So always avoid the beginning of a session or the end of a session, the beginning of a week or the end of a week. Okay. I'm seeing here my meeting could be ending soon because of time limit. There's a time limit of 40 minutes. I'm seeing here. Okay, so if anything, I'm going to share again the link so that we can just continue. Let me just continue with you. When the meeting is over, I'll share again the link. Then we can continue and then finish off. Now I want to talk about the moving averages. The reason why I actually want to talk about the moving averages is because all that I'm saying now is going to be summarized by the moving averages. Okay, so let me show you what I mean by moving averages. Okay, right. So when you've got a chart, your MT4 chart, what you need to do essentially is to have your candlestick chart and then create you have to insert an indicator there, right? Indicator would be trend indicator, and then that would be your exponential moving average. So where are your moving averages? Moving average, right? On moving averages, we have got the, okay, can you see my MetaTrader? Okay, can you see my MetaTrader? I'm trying to, oh, we got unlimited time. Okay, no problem. Ah, that's great. Right. So let me show you how I use the moving averages to actually see what the market maker is doing. Okay. It's not about just knowing what the market maker is doing, but having the ability to get the moving averages. Okay. So let me show you. Okay. So now moving average number one, we use 5 moving averages, okay, on one chart. So 5 moving averages on one chart, that is the EMA 5. So we change there on period to say period 5. Then the method is exponential. Usually the chart is automatic on simple. You click on that and then you go to exponential. Then you apply to the close. Okay. My color code is usually red for the 5 EMA. Okay. So I have my 5 EMA first, and then I insert again moving average, the 13 moving average. Then that one I'll put it on yellow. Okay. So it's 5 and 13, and then insert indicator, trend, moving average. Okay, moving average. 50. Moving average 50, that's the next one. That one I use aqua or water. Right. Next, insert indicators, trend, moving average 200. That one I'll put it on blue, navy blue, or dark blue. Okay. And then the last one, which is EMA 800. Insert indicators, trend, moving average 800. Right. This one I'll put it as let me find another color. Let me just say light some, whatever color that I'll use now. Right. Now, this is the interesting part about the market maker method, and how you can actually spot what the market maker is doing. Let me zoom out. Okay. Now, every time the market moves, like I said, the market moves in 3 cycles. Okay. Always remember that. The market creates a peak initially. So we have something like this. This looks like a head and shoulders pattern. Okay. Actually, it's this one here. Let me erase this. This looks like head and shoulders pattern. And then after this head and shoulders pattern, the 5 and the 13 EMA crossed the 50 EMA. So we've got the 5 and the 13 EMA. When they cross, let me just put an X to show that they're crossing. When they cross the 50 EMA, that marks the beginning of a trend. Okay, that marks the beginning of a trend. So this cross here is facing downwards. So this means the market is going to go down from here. After forming the peak, the market is going to go down from there. So this will be your first entry. I'll call it E1. Okay. When the market goes into the 50 moving average or below the 50 moving average, expect it to bounce back. Okay. Now, this bounce here, these are what are known as stop hands. What the market maker is doing is, after people have spotted a trend, or after the trend has persisted long enough, people usually enter, right? Because they've seen, oh, the market is actually going down. So the people enter. There on the 30th of March, people entered sell on the Euro USD. And then what the market maker did was he spiked the low, came back up so that he can hit the stop losses for those who sold late. And then from there began the first level, which is level 1. Now this trade where the 50 EMA, where the market bounces on the 50 EMA, is what is known as the ID50, and it marks the beginning of level 1. It marks the beginning of level 1. Please note, the market always, when it forms a peak and it passes through the 50 EMA, it comes back to the 50 EMA and bounces from it. The 50 EMA becomes a better measure of support or resistance than just your ordinary horizontal lines. Okay. And what makes me confident is you can backtest this. Okay. You can backtest this and see whether this has not been happening before. Let me wrap this off the screen so that you can see what I'm talking about. This is the previous week. Let's see what happened. We have got a peak formation here, something that looks like a triple bottom or a head and shoulders pattern. Then we've got the 5 and the 13 EMA crossing here. After this crossing, which we called entry 1 or E1, the market came back and hit the 50 moving average, which is your aqua, this light blue line. And then it went up. Every time you see the market bouncing on the 50 EMA, that trade is called an ID50 trade. And when you take an ID50 trade, chances are you are going to immediately get into profit. You are not going to hold your trade in any loss. Okay, that's the beauty of an ID50 trade. That's the beauty of an ID50 trade. Let's see another ID50. We've got a peak formation here. Then that's an ID50 trade there when the 5 and the 13 EMA or 5 and 13 exponential moving average bounced on the 50 EMA. When you are able to take that trade, you have, I wouldn't call it a guarantee, but you have some form of sureness, okay, to say I'm going to enter a trade, I'm going to place a tight stop loss. Now, because of the limited time, I may not be able to get into every detail of these entries. So I'm going to try and write, the summaries down, and then we come back to the charts so that we can see if what I'm saying is true. And forgive me for, like I said, we've got many limitations. We've got the time limitation where people are in different time zones, and then we've got other people who are, who specifically requested that we try and be fast. So allow me to share what I'm going to be talking about here. This weekly trend that I was talking about, if you see an ID50, choose, that spend the next either 3 days on the rise, or it's going to rise for 3 levels. I'm going to explain how to count the levels, okay? But like I said, ID50 trade is the beginning of level 1. So let me illustrate that in a diagram. Right, we said we have got the EMA 5, we have got the EMA 13, we've got the EMA 50, we've got the EMA 200, we've got the EMA 800. Now I said EMA 5 is which color? EMA 5 is red. EMA 13 is yellow. EMA 50 is water. EMA 200 is dark blue. EMA 800 other color. Hello? Okay. So first trade. Hello. Mr. Techno N8, L8 plus. I cannot hear you. It seems you wanted to say something, or maybe your microphone just. Okay, all right. So this is what I'm saying. Let me draw them in their colors, okay, so that you see what I'm talking about. The EMA 50, let's say it's like that. The EMA 5 and the EMA 13, when they cross together on the EMA 50, there, in this point here. When these two EMAs cross on the 50 EMA, that's your first entry. Why is this your first entry? This is your first entry after a peak, okay? After you have seen maybe a W or a double top, a double bottom, or you have seen a triple bottom, or you have seen an inverse head and shoulder. And then when the market comes back and bounces off of the 50 EMA, let me get this red color, right? And the market comes and bounces off. Here, and the market comes and bounces off of the 50 EMA. This is what I'm calling the ID 50. Now, I use these moving averages to do my level counting, okay? Level 1 is your ID 50. And then what happens after the ID 50 is this. The market forms a cross. Now this cross, some would call it a golden cross. Right? That's textbook definition, okay? A golden cross where a 50 and, where two moving averages cross and it signals some bullish momentum. So when there is a golden cross here, like this, what this signals is called a peak lock. It means our peak is locked. If we had a W, what it means, it has been confirmed that the market is going to go up. So if this is level 1, we're expecting the market to do a level 2 rise immediately after this peak lock. It may come back down and touch the 50 EMA again, or it may not, but that would be your level 2. Now, all of you guys who want to be swing traders, all of you guys want to trade stress-free, okay? This is a very important tip. Let me show you using the charts, okay? This is going to actually make you better traders. Let me show you using the charts. Every time you see a peak lock, okay? Let me show you a peak lock here. Let me share my screen, my empty 25. Okay. When you see a peak formation like this, and then you trade an ID 50 like this one, you enter here, let's call this E2. You enter there on ID 50. When you see a peak lock, this one, that's a better measure of support. What you do there, you draw a horizontal line on that point there, the market will not come back there for a while. So these are the conditions. Condition number one, you see a peak formation. After you see a peak formation, you see the ID50, which is a bounce by the 5 and 13 EMA onto the 50 EMA. That's a good entry. And when it is confirmed by what is known as the peak log, which is the crossing of the 500 of the 50 and the 200 EMA, you can hold your trade for as long as you want. Of course, not as long as you want. For as long as you can count the levels, okay? The whole point is about counting the levels, okay? But the market will not come back down for a while. Let me show you another peak formation. At GBP USD, let me show you a peak formation and then an ID50 trade on the 3rd of April, right? 3 April, right? To the 30-minute chart. For illustration purposes, right? 30-minute chart, there we go. Let me zoom out. Now, we have our 30-minute chart here, and it seems a little bit noisy, like the chart is a bit noisy. We have got a noisy chart there, but you need to cross the 50. Like I said, that's your first entry, E1. And then the market came back and it bounced on the 50 EMA. That's your E2, your second entry. When the market does that, you enter and then you start counting levels. Now, how do you count your levels? Like I said, the ID50 is level 1. So you count your first level. Let me zoom in so that you can see how the counting goes. Right. You see the first here when the market came this side and hit the 50 moving average, the market went down and then it spiked. This candlestick here has got some funny property. It has got a pin or a shadow, okay, to the upside, which is a mark that we want to start a new level. So what you do is you measure the number of pips between your entry, which is the 50 EMA, to the point where the last candlestick went to, right, before the spike. So there, if we measure that, that's 60 pips, okay, or 608, or 600 points, which is 60 pips. What it means is if you have seen your level 1 to be 60 pips, if you're going to hold the trade for the entire 3 levels, you're going to hold the trade for 180 pips. So once you measure that, you can hold your trade or you can place your take profit 180 pips away, which is almost exactly where the market turned. If you can see there, that's almost exactly where the market turned at 180 pips, and then it went back up. So I may not be able to explain everything. Like I said, it's one video, okay? There's a lot of information that I could share, but then unfortunately we are limited with time. Okay, so let me show you a very, very nice setup of a swing trade on the 24th of March, like I saw. Okay, something is happening. Okay, let me see, 24 March. 24 March. Just want to show you something about, you know, how to spot an ID50 on the 1 hour chart, how to spot the same ID50 on the 4 hour chart, and then why it is important for me to teach you about the ID50. Why is it such an important trade in, you know, in your trading career? This is what I'm looking for, the 24th of March. Okay, so I am there. I'm on the 25th of March. Yes. So this is something that happened. Now, on the 24th of March, where is my pen? Right, there it is. On the 24th of March, we had some peak formation, and then the 5 and 13 EMA crossed the 50 EMA, and then it went up, came back down, and it hit the 50 EMA, started rising. Now, like I said, you check every time the market bounces off the 50 EMA, it was up or down, depending on where the market is going. What is the intersection of the 50 and the 200 EMA? And I said, once you identify this peak log, you draw a horizontal line. Okay, you draw a horizontal line. What it means is the market will not come back down below that peak log for a very, very long time. Now, if you see a peak log on H1, and then after the peak log on H1, you spot an ID50, right? So let me write this down. Peak log H1, then an ID50 on H4. Once you see these two, it's a confirmation of a swing trade. It's a confirmation of a swing trade. If you look here from the 24th of March, the 24th of March, I said there is a peak log, right? On H1, we saw the peak log that we drew just a few moments ago. And then we have an ID50 here, where the market initially it crossed over the 50 and then it came back down and it's bouncing on the 50 EMA. This is confirmation. If these two follow each other, you enter a swing trade. And that swing trade, you enter at the ID50 of the 4-hour chart. The market will not come back. The market will not come back down to that level for a while. If you check, if you had entered on the 24th or around the 26th, the 24th, 25th, when we drew our peak log, if you entered there, what it means is from the 24th, 25th, 26th of March, you would have been holding your trade, and then you spot an ID 50 here, maybe you re-enter, or you just leave your trade running, knowing that the market is not going to come back down for a while. After the ID 50, we know that there's going to be a peak lock again on H4, which means the pound is on the rise, okay? And nice thing about these moving averages, the next moving average is your take profit. It's very, very as simple as that. When you look at an entry, let me show you. When you look at an entry, let me show you something funny. So you won't even struggle on setting your take profits. When you look at an entry, H1, where are you? When you look at an entry like this one, the ID 50 here, your take profit would be the next moving average, which would be the 800 EMA. If you enter this trade here, the first entry that we talked about, the 5 and the 13 EMA cross the 50 EMA. If you enter that one, your next take profit will be the next moving average. So there is not much need for you to stress when you see the market hitting the next. This is the reason why I really had to come to you and explain these things, because I've seen in a lot of group chats that I'm in, people are wondering, where do I place my take profit? When you've got these 5, it's very, very easy. The next is either you count your levels. If you're going to enter for the entire 3 levels, you count how much one level is worth, and then you just multiply that by 3. That's equal to your take profit. Or you look at the next moving average. Where is the next moving average? The next big moving average. So if you entered using the 50, the next moving average there is the 200, which is this one. So when you entered using the 50. So your take profit is the 200 moving average. If you enter using the 50 and the 200, the next take profit is the 800 EMA. This is to avoid situations where the market does not actually reach your target, a moving average. So try to place your take profit maybe a little bit slightly below your moving average. Okay. I'm hoping we're still together. Please do feel free to ask. I feel like I'm losing a lot of people here. Okay. Okay. Usually I analyze my charts on H1. H1 gives me a clear representation of what is happening. Why? Because there's not too much noise on H1. On the 1 hour chart, there's not too much noise. On the 15-minute chart, 30-minute chart, there's a lot of noise, there's a lot of movement happening. I should mention this. This is very, very important. Don't trade every day. I trade what I want to see. If I don't see it, I don't trade it. A lot of traders try to force themselves into trade. They try to force opportunities. Just trade when you see an actual opportunity. Let me show you. So if you let me show you, maybe you think it may work only on Euro USD or pound. Let me show you. This is your USD Swiss franc. USD Swiss franc here we've got set up, right? We've got an extended M here. We've got 113. We are crossing over the 50, right? E1, first entry. The market goes down, comes back up, hits the 50 EMA several times, and then goes down again. This is your ID 50 trade, ID 50. As you can see, if you're going to enter an ID 50 trade, you are not going to get stressed. Your trade is not going to come back up, and then you are holding a trade, you're holding a trade, and it's never coming into profit. If you enter an ID 50 trade and it doesn't immediately go into profit, you enter too early, okay? So you enter into an ID 50 trade there, you see a peak lock. Once you see a peak lock, what does that mean? What does that tell you? The price is not going to come back up for a while, okay? So what do? You come and draw a horizontal line there, that place where the two moving averages intersected. And then you hold your trade. So I don't know if I'm making any sense. Please do communicate with me through the comment section if I'm making any sense. If I'm not making sense, please just tell me. Or if I've overstayed my welcome, please do tell me. And if you're not hearing what I'm saying as well, please do communicate. Okay, you can go to your chat and drop a comment. Okay, so that's USD Swiss franc. Same formation. Okay, loud and clear. I can thank you very much for the response there. Who else? From Paul. Oh, thank you very much, Paul. Thank you very, very much. So look at this. 1, 2, 3, head and shoulders pattern. 513 intersection. Entry 1. Market comes back down. Here's the 50 moving average. Entry number 2, which is your ID 50. The market goes up. This is level 1. How do I count level 1? I come to my crosshair over here and I measure the rise. That's how many bars? 80 pips. So what do I know? I know that if level 1 or ID 50 is equal to 80 pips, then I have to multiply that by 3. 80 trade for 240 pips. Can I? Let's see. Ooh, just missed. That's about 186 pips to the peak. So yeah, it's not an exact art, okay? It's 189, 190 pips. So what you ought to do is you set your like I said here, this M pattern here was going to also signal that you have reached a peak, so you can actually exit on this entry here on E1, the next E1, you can exit there. Still you're in profit, okay? It's not like you have to, it has to be as accurate as that. The market is also moved by fundamentals, okay? In fact, it's these market makers that trade the fundamentals in such a way that they manipulate the price. Okay, so the price has to have an explanation as to why it's moving in a certain direction. So they have to trade using the same fundamentals. 1, 2, 3. To set up the EMA, the market starts to go down. This is like, and on every chart, if you go to any chart, yes, it requires practice. It really requires practice. For me, because I've been trading for a long time, I can spot a trade way before it even forms, you know. But and look, I'm going back. This is 8 March, 9 March. I'm going back. Same thing. Nothing changes. Okay. You've got a peak formation. You can see by all these weeks that there's a lot of trade to first entry. And the market comes and bounces here. Okay, it did bounce maybe 3 to 4 times, but that's your entry again to ID 50 for first level, right? Okay, it's like hello. Techno, talk to me. I'm seeing you say, why is he not using his microphone? Hello. Let me unmute. Okay, let me check what's happening. Let me check what's happening. Hello. Okay, guys, I'm having a slight challenge this side. If you could just allow me to exit the meeting for less than 5 minutes and then rejoin. I just want to fix a small problem here on my PC.
No. David. Did you say? David, did you say?
What did I remove?
Mushe go adi.
Did I get right?
Ka zoom na sina ka zoom na sina ka zia.
Oh.
They go na ka advertise pa TV.
Okay. That's great. The guy is not out after the meeting.
Okay.
Right.
Okay. kanoshandiswa foni munozokashandisa kukafoni ndikaziyewo.
Oh, all right.
Okay.
Okay, thanks.
Hello.
Hello?
Hamusi kubva sei?
Kubva pai futi?
Ndiri kukuonai.
Imi kubva pai, Mr. How do I get out?
Ndiri kukuonai. Ini ndicharamba ndiri meeting.
Ramba yenyu murimo. And everyone is there.
Oh, koma override sei imimi.
Override chi? Konda override chi futi?
Meeting. Sei ndiri kuona mimi. Kusikaonewa meeting.
But I think on SRM, I think what was that kutaura?
Kata. Okay.
All right.
Kata.
How do I?
Hello, guys.
Hello.
I'm back. Yes, I'm back. Sorry for that. I've just been sorting out a small problem with my PC, but I'm back now. So let me go back to what we've been sharing so that we can quickly round off the meetings, because I know some of you would want to, go back to do what you have to do. All right. So this is it. We've been going through the US Euro. This is what Euro card. Okay. Well, it's the same patterns, guys. It's just the same patterns. There's nothing different. Everything is just the same. The market comes into the 50 EMA. Sometimes it's not as clear as daylight. Okay. Like here, the market came into the 50 EMA and then it bounced off the 50 EMA, but it wasn't so clear. But once you see, like I said, once you see this cross here, this cross is very, very significant. You need to draw a horizontal line there. And then you know you are trading a sell, and your stop loss, which is what I want to talk about now. Your stop loss has to be 15 to 20 pips above either the high of day or the low of the day, depending on whether you entered a buy or a sell. Okay. Always try to make your stop loss about 50 pips. 15 to 20 pips above or below your high or the low of the day. So let's see other setups. USD Japanese yen. I think I gave a signal somewhere about USD JPY. Let me see how best I can illustrate this. M30, I want HY. Okay. I think I gave a signal somewhere on USD JPY, but I'm not going to talk about the signal. Let me just talk about the pattern here. We've got this pattern here, looks like a W pattern, the double bottom. These two spikes should tell you, the spikes are the ones that should be an indicator to you that we are not going in that direction. Okay, let us stick in your mind. If you see spikes like this, know that the market is not going that way. Okay, usually those spikes, what they mean is this. Someone drew a line of resistance or support at that point, and then the market had a fake out or a fake breakout, a fake out at that point. That is exactly where the market makers will be trapping people. Okay, that's where the trap is. When you see this, this is what is known as a stop hunt. The market maker is hunting stop losses and is hunting stop orders. So it's a stop hunt. Some people had put buy stops there to say, if the market surpasses this region, I am in a buy. Then they buy, and then immediately when the trade is activated, the market starts going in the opposite direction. So don't trade support and resistance based on horizontal lines. Please, that is not a good idea. That is definitely not a good idea. You would rather trade the support and resistance based on moving averages. Okay, when the market spikes like this, then you enter here, there's an entry, it comes back down, it bounces off the 50 moving average, it goes up, that's your level 1. This was a clear one. Level 1, level 2, comes back down here, it forms like a flag, level 3. And usually level 3 again is also marked with stop hands. And this looks like an M. So the market is going down from there. So there is no need for you to panic when you know when to enter. Okay, I'm going to try and have another Zoom session, most probably this coming week. Okay, I'm going to try and manage maybe 1 or 2 more Zoom sessions so that I can explain the market maker cycle. Unfortunately, because today I was in a rush trying to make sure that I fill everyone in the gap. Maybe today's session, or maybe the questions that you're going to ask today, could be a better guide of what I'm going to have to explain the next time that I come to you. Okay, but like I said, you need to be able to spot the peak formation. Then once you spot the peak formation, you have to be able to identify the first entry. Once you identify the first entry, you have to be able to identify what we call the ID50, which is a bounce on the 50 moving average by the 5 and the 13 moving averages. And then the market will start going up or going down, depending on whether the market, the crossovers are crossovers going down or they're crossovers going up. But this is a better measure of understanding market maker behavior. It's more accurate in determining when the market maker is actually going to create the stops, because many people, they know how maybe the market maker moves, but they may not have an idea of how the market maker, where exactly the market maker is going to. Okay, there's a question here, on which time frames does this mostly apply? H1 or H4? Because I see you have been switching. Okay, so you have to know that it applies on all time frames. Okay, actually applies on all time frames, but the reason why I switch from H1 to H4 is because myself, I don't like short-term trades. Okay, so I usually take swing trades. I gave a setup for a swing trade to say, if you see a pick, lock, and an ID 50 on H4, you enter a trade for days, right? But it applies on all time frames. Let me show you. Let me go to the 15-minute time frame. I think that's the minimum I would expect any proper trader to be trading on. Don't go below the 15-minute time frame, please. Let's go to the 15-minute time frame. Okay, this is the 15-minute time frame. Let's see what happens. Okay, same thing. You've got a peak formation here. I don't know what to call this. It looks like a head and shoulder. Right. Then we have the first cross there, E1. Market comes back, hits the 50 EMA, starts going down. That's your ID 50 trade. And this is the 15-minute chart. So you can still use this same method to trade on any time frame, but I recommend you do it on the 1-hour chart personally, because that's what I do. The other charts, there's too much noise going on there. There's too much activity happening. Okay. So if there's too much activity happening on these charts, I wouldn't recommend you to be, trading. Like if you can see here, right? It is not so clear. Where are you? And 30 and 15, right? If you can see here, it's not as clear because the market came and there was an intersection here, then came down, then went up. You can see the bounce is not as clearly defined when you're looking at the 15-minute time frame. Okay, but when you go to the 1-hour time frame, 1-hour time frame, one-hour time frame is a little bit smoother. Let me see how I can illustrate this. Okay, there's a peak formation here, and then there's trade number 1, trade setup 1. Then it doesn't really come back. It goes immediately into a sell, right? So the 1-hour chart is a little bit smoother than the 15-minute chart. If you look at this setup again, comes back down, goes up, comes back down, goes up, right? It comes back down, expecting it to go up a bit. So it doesn't go up the entire 3 levels. It went up 2 levels. Now these are situations where the fundamentals now come into play. Okay, the market may not necessarily go up 3 full levels. This is because you have to also be checking your economic calendar to see if there is no news on that particular currency. Okay, so like I said, set your take profit as the next exponential moving average. So in our case, this was going to be our take profit. If you enter here, your take profit was going to be that over there. So it's between 107.8 to 108.4. That's about what, 60 pips, right, on one level. And then if you're going to spot this pullback over here, when you enter again, right, most probably your next take profit would be 60 pips up again, because it's one level is equal to 60 pips. One level is equal to 60 pips. Okay. So the counting of levels is not an exact art. Like I said, it's not an exact art. You can't really say it's always 80 pips, it's always this number of pips. There are tools that are there that I'm going to maybe share during the next time we meet. But I wanted to at least be able to make this available for you. Then you can go and look on your charts. Try to back test what I've been talking about on different currencies. On any currency really. Okay. Look, same thing. I remember sharing this setup in a particular group. This one. It didn't come back down immediately. Right. There was a peak formation there, and then there was the first entry here. And the market went down. It came back up, but it didn't immediately bounce on the 50 EMA. It went a bit up again. And like I was saying that other time, your stop loss should be 10 to 15 pips above your high of the day or the low of the day. In case where you have a peak like this, your stop loss should be above your peak. Okay, this was a swing trade. If anything is to go by this, this was a swing trade. Let me show you by the 4-hour chart. Here is the 4-hour chart. When you see the 4-hour chart and the 1-hour chart coincide, or they're forming a peak at the same time, that's a good setup for a swing trade. Okay. So there was a peak there. Very nice peak on the 4-hour chart. Looks like an M. Then we have this first entry. So, okay, there is a question here. How does news affect this strategy? Okay, so this strategy, what you have to know about this strategy is this. Market makers, they trade fundamentals, okay? They trade news. They use news to push the price. How can I even explain this? Okay. If there's anyone who can explain fundamentals, I'm sorry, it sounds like I'm going to be tooting my horn, but I really understand how fundamentals work. Okay. Let's say there's news, let's say it's the NFP, non-farm payrolls. It's time for NFP. News, what it does, it introduces either level 1 or level 3 to the equation. This is what market makers use what they do is they push price just before the news in such a way as to either form a peak before the news or to form a stop hunt before the news so that they can create a new level, which is level 1 or level 3. So this is what happens. Let me draw on a whiteboard before and after news. Then you can understand what I'm talking about. I'm not saying news is not important. Please hear me out. News is the most important part of trading, especially with this strategy. This is what I'm saying. Let's say the market has formed W, then it has moved level 1, level 2, right? What happens is this. Level 1 is usually induced by one of two things, either volume or news. Level 1 is usually volume or news that pushes level 1. Level 2, this is where many people make money. Many of your normal traders, the ones that trade breakouts, the ones that trade all these other kinds of analysis, they make their money on level 2. Why? Because level 2 is a more clearer move of the market. The market moves more clearly on level 2. In fact, level 2 is a set of same color candlesticks. I'll show you on the chart. And then what happens is the market maker will not allow the price to move beyond level 2 before news. Why? Because news has to either be used to trap people who are buying on level 2 so that they can start level 3, or it either has to be used to go to level 3 to trap other people so that the market can start going back down. So they do trade the fundamentals, but they always stick to this psychology of 1, 2, 3. Why? Because they know many traders ignore news. Many traders ignore news. A lot of newbies in trading, they ignore news, and they're always trying to find ways of trading technical. So because of that, market makers take advantage. Okay, so I hope what I'm saying makes sense. I'm trying to strike a balance between explaining this and keeping my time. Let me show you something on the screen. Level 1, level 2, level 3. Let's see what I'm talking about when we talk about level 1, level 2, and level 3. Right. Level 1. Level 1, I said this, your ID 50. There it is, that's level 1. Those were just a few candlesticks. And then there's a stop hand there. So my screen moved. So here, there's level 1. There's a stop hand here. And then level 2 is almost consistent. It's a consistent rise or a consistent drop in price. Level 2, this is where people, ordinary people, ordinary traders make money. Yeah. It's almost very, very consistent. Every time you see level 2 is straight drop or straight rise. Okay, let me find another example for you. Let me go back a bit. There we go. There's an ID 50 here. There's level 1. The market comes a little bit back down there, or start here, right? Then there's level 2. A whole lot of green candles there. The market is going up. Level 2. Then we've got this. And we've got that 4. And then we've got level 3. So for me, it may be a little bit easier to be able to count these levels, because I've been using the same strategy over and over and over and over again. Okay, but it may not necessarily be as easy to everyone else. Okay, let me see, there's another comment. Thanks for sharing this information. Do you share analysis whenever you spot ID 50? Well, I do sometimes, not all the times. Unfortunately, it all depends with which is I'm dealing with, because I do have a free group, but I don't want to like advertise for people to come into my group or something of the nature. Okay, you people are coming from different groups, you're coming from different places. I don't want to be marketing. Well, it's a free group though, but then because of the restrictions that have been placed by your administrators in your groups, I wouldn't want to say, come into my group or do what. No, I'll try to share them in those groups, okay, where you are, so that I don't seem like I'm trying to lure people into following my strategy or something of the nature, okay. So I'm going to be sharing my ID 50s. Maybe because you've placed this request, you guys, I'm going to be sharing my ID 50s with you. Let me do this. I can see there's some people that are not necessarily in the groups that I'm in. So what I'm going to do with okay, or maybe if you want, you can just send me a text after this video, and then I can share with you personally. Okay, I think that would be far much better. I can have my list of people. You just 9 at the moment, so I think that's a number that I can handle. I could be sharing my ID 50s, but the whole point is I want you to be self-sufficient. You should be able to identify these ID 50s at any given point in time. Just know that the ID 50 is equal to the 5 and the 13 bouncing on the 50. And that's it. When you spot an ID 50, and for me, I think it's less stress. I tell you, there's not much stress in my trading anymore because of that. Just spot that, and then I enter. Okay, the markets have opened for, let me see, is it? Or maybe I'm seeing things there. Okay, hold on a moment. I just want to check something. Okay, so maybe I can give you a few setups for this coming week. Then you can look at them, maybe see if you want to take trades on those setups. But here is one. There's an ID50 here on euro, right? And there's a level 1 rise to that point. So what does this mean? It means the euro is most probably going to just bounce and go up. Okay. This is my analysis for the coming week. Okay, so the euro is most probably going to bounce and go up. Then we'll see maybe at around which levels now. How many pips is this? This is 85 pips. So the next level rise could be up to 85 pips. Where are you? 1.10. Okay. So next target for euro is 1.10. Let's see if we don't have an ID50 on the 4-hour chart. If we have an ID50 on the 4-hour chart, that means it's a swing trade. So the ID50 on the 4-hour chart is not fully formed, so I don't see it. I don't see an ID50 on the 4-hour chart, so this is not a swing trade. So be careful. Buy up to 1.10. That's euro. Then pound. Pound usually moves in the same direction with the euro. They are positively correlated. So I'm expecting a slight fall in the pound and then it goes back up. Okay. So this is your 4-hour chart. We had an ID50 here. This is level 1. So we're expecting something like this, level 2, level 3. Level 3 will be stopped by this moving average here, the 800 EMA. So that's your next target, level 2, level 3. Now, I'm ignoring news in all of this, okay? But when there is news, you have to be careful, right? You have to be very, very careful. So level 1, level 2, and level 3, that's what I'm expecting. Let's see what else. So don't trade everything that moves. I always tell people don't trade everything that moves. Find a proper setup. Okay, find a proper setup. Okay, there's no proper setup here. Let me leave this alone. Maybe find one more. Okay, there's a comment. USD-CHF. Okay, let's see USD-CHF. All right. USD-CHF is not as clear as. Oh, okay. So this is what I see on USD-CHF. There's a pattern here. There's the first entry, and then there's the ID50 here, level 1. Then it could come back up to the 50 moving average and then come back down. So we're going to trade a sell on USD-CHF. Just make sure you place your stop loss above the 50 moving average. Okay. So this is what I'm expecting on USD-CHF. And please, with a setup like this one, where the market fell so hard on the first cross here, trade to level 2, don't trade to level 3. So how many pips is level 2? That's how many pips is level 1? Level 1 is 69 pips. So we're expecting around 69 pip drop from somewhere around here. 69, which is 0.96. So next target is 0.96 for USD CHF. 0.96. Okay. Let's see. Yeah, USD CHF moves in opposite direction of Euro USD. Yeah. So we're on a buy on Euro USD. We're on a sell of USD CHF. What else? Well, I think you can analyze other pairs. Okay. For me, I don't advise people to trade on Mondays. Like I said, Mondays is usually consolidation. So I wouldn't advise you to place your trades on Monday. Monday, you can just be monitoring your charts. And then towards the end of Monday, you have a few pairs that you selected and say, I'm going to trade this pair and that pair. Okay. That's it. I think I've tried the best I could to have maybe give justice to explaining some of this. So let me create a group. Let me create a group where this video will be posted. Let me see. Let me see. Yeah, as I'm creating the group, you could type if you've got any questions or issues that you wish to be addressed in your group. Add people. Oh, I have a lot of people who are still asking if you're still on Zoom right now. So yeah, I'll have to have a second session, definitely. Let me add one person there. Okay. Right, and then say group name, Zoom complete trader. Right. Then let me see. It's a private group. Let me make it a public group and just call it Zoom underscore complete. Right. So you can join. There's a group that I've created called Zoom Complete Trade. It currently has 2 members in it. So that's where the video will be posted. Let me write it on the screen. Summary of this strategy: first entry is cross 518, second entry is bounce of 518 and 50. Pick lock is cross of 50 and 200. Wow, thank you very much, Mr. Ayodeji. Okay, let me post the link here. t.me/Zoom underscore complete. Right. All right. Yeah. So You could still, if you feel like maybe you're not able to join the group or whatever, you can just text me. You can just search for me. Me slash the complete trader. Okay, I'm seeing there's some people who've joined: Rima, Max M, DJ, Paul N. Okay, so thank you so much, guys, for joining me. I'm really happy to have shared this information with you guys. And let me see. I don't even know how to unmute your microphones. Let me unmute. Yes, I've unmuted Miss Debrow's microphone. Daisy.
Yes, I'm here.
Oh, that's great. That's great. Mute. Unmute all. Oh, okay. I found the button. All participants are unmuted. So yeah, I think all of you can speak to me now. Except for Mr. Ayodeji, Meisha, and Paul. I don't know what happened with these ones, but maybe they've just muted their own microphones. Okay.
Thank you so
Okay.
much, Mr. Innocent, for sharing with us such priceless information, actually.
Oh, thank you very much.
Thank you very much.
For joining me. It's been a pleasure to be having you, sir.
Thank you so much. Appreciate you getting on.
No, thank you. Thank you.
Thanks, my brother.
No.
Very informative.
No, thanks.
Bye. Thank you.
All right, bye.
All right, thanks a lot.
Thank you.
Okay.
Thanks a lot.
Okay. I'm going to post maybe next time I have another Zoom session, maybe let's say Friday, Saturday, or Sunday this coming week. I'm going to have another one so that we can really get deep into some of these concepts.
Yeah, that will be awesome.
I would like that.
Yeah.
And then
That'll be great. Yeah.
we can look at these traits that we like EU and UC and see how that played out and look at the cycles, because that part was very valuable to me, especially looking at the Asian, London, and New York sessions, learning about, how they behave and what we can be looking for. I think that part was really
Okay, the next time I'm going to share, I'm going to share with you the actual time that you need to be looking out for, and specific candlesticks. Yes, like the 9:45 candlestick for the New York station. How you can actually tell where the market is going by just looking at one candlestick. So I'm going to be looking at that as well next time we meet.
Okay, great.
Okay.
Okay, then the other thing, your links. Where do you post them, your links for your Zoom sessions? Because I found this one on the, is it Forex in Africa group?
Okay, okay. Yes, you're saying, where do I what?
Where would you post your links for the meeting? Your next
for the meeting.
Yeah, is it in the same group?
Yeah, I'm going to post it in the same group. I'm going to try maybe to not dissolve this group till we have a second meeting.
Yeah, I'd
Maybe-
appreciate that if you can keep this group open until the second meeting.
Okay, oh, that's great. That's great then. So I'll definitely post the link in this group, and then also in that Forex in Africa group, so that at least everyone could, invite your friends, invite whoever you would want to see making money with Forex. Yeah. All right. Thank you very much, guys, for joining me.
Thanks, my friend. You have an awesome evening further.
You have
All right,
a,
cheers.
thank you so
Okay.
much. Thank you
Hello.
guys.
Okay. Have a good night and have a good day.